Hi, everyone, and welcome to our webinar, Tokenizing Impact, ESG Mortgage Investing on Hedera Hashgraph. And we're going to talk about a new approach to investing in, verifying, and tracking the performance of ESG mortgage investments on Hedera Hashgraph decentralized ledger, which is accessible to both Web 2 and Web 3 investors. So I'm Shima Rayej, co-founder and chief investment officer at SafeRate, and joining me today are Tom Voutsos, co-founder and CEO of LadderUp Housing, Dylan Hall, co-founder and CEO of SafeRate, and Steve Papermaster, founder and CEO of First Title and Escrow. If you do have questions, please feel free to type them in the chat box. We'll do our best to provide a written answer during the webinar, but we're also going to record this session and share answers to all the questions in a follow-up. So, feel free to, expect those answers afterwards as well. So despite their growth over the past decade, ESG investments, especially those targeting ESG fixed income, are still facing headwinds. There's a lack of investment options, and what that means is that because of the imbalance of supply and demand, investors are paying high premiums for these sustainable investments. It's also difficult to actually verify the impact of the investments and their alignment to ESG mandates. And in general, private equity fixed income investments, they lack liquidity and require additional support to provide secondary market trading for these investments. So SafeRate is leveraging decentralized ledger technology to overcome these problems. We are onboarding quality ESG fixed income assets to Hedera Hashgraph ledger for complete transparency of impact and performance of these investments. The investments, ESG qualifications, underwriting, and collateral information are all independently audited and attested to prior to the investment becoming live on ledger. We're also servicing these assets and remitting payments to investors, all of which is managed for investors, so it's tracked on ledger. And we're also creating the ability to have a secondary market and provide liquidity for these investments using DeFi liquidity. And Dylan will get more into the details of the implementation later in the talk. So with this approach, investors are able to have answers to questions that they previously didn't have answers to. So for example, in general, what's the impact and return for every dollar that I've invested? And then more specifically, questions like, what's my allocation to the United Nations Sustainable Development Goal #1? Or what percentage of my loans are made in Community Reinvestment Act eligible census tracts? And so we're really excited to share that, for our first pilot, we're going to be partnering with LadderUp Housing to provide financing for the development of workforce housing in Toledo, Ohio. So these are short-term renovation loans, 3 to 6 months, for rehabilitating workforce housing, specifically regionally in Toledo to start with. And LadderUp's unique approach provides a pathway for people who are earning an average of $18 an hour to first comfortably rent and then eventually purchase the home from LadderUp over the course of 2 to 5 years. The efforts actually specifically address United Nations Sustainable Development Goals 1, 8, and 11. And we also expect a competitive risk-adjusted return on these loans in the range of 9 to 12%. In the future, we can become the mortgage lender for the renters, which gives us a pipeline of borrowers and the ability to create this full circle impact in housing. So on that, I'll hand it off to Tom to talk more about LadderUp's program and the impact that they're having.
Thanks, Shima. Appreciate it. So as Shima said, my name is Tom. I'm the CEO and co-founder of LadderUp Housing. I wanted to start this talk with two of our current tenants and two of our first tenants, Ben and Renesha. Ben works for a local contractor, and Renesha is a mother of two who works at a local hospital system. Despite their good financial behavior in recent years, they're unable to access their housing goal of home ownership. Like Ben and Renesha, millions of working class Americans are currently shut off from owning a home. And so the housing market in working class communities is broken. It doesn't provide the variety of options that suits the desires and needs of residents living there. Further, American household wealth is driven by home ownership. So there isn't a method to convert renters into homeowners in our working class neighborhoods today. We interviewed over 50 housing experts, community leaders, and prospective tenants, and found that credit score and lack of familiarity with the process was preventing people from becoming homeowners. Further, existing lease-to-own options only target the largest metros and people making 120% of AMI and up. Minimum credit scores required are typically 620 and higher, and the largest players don't target our customers who are making between 60 and 100% of the area median income. So we created LadderUp Housing to seize this opportunity and attack each of the barriers mentioned earlier through our pathway to home ownership. We purchase and renovate homes, rent them to tenants while they build their credit score, working with a nonprofit financial coaching partner, and then sell that same home to the tenant once they're ready. So I wanted to dive into each of these elements of LadderUp's process. When it comes to neighborhood selection, we take a much more detailed approach. While many investors look at neighborhood data at the zip code level when determining investment, we dive into census tract level statistics to tease out insights that directly correspond with livability for our target market. Once we've selected a neighborhood, we drill down further to target homes that require mainly cosmetic repairs, such as kitchen remodel, bathroom remodel, floors and paint. We stay away from properties that have major structural deficiencies, although we do have a line item in each of our renovations for systems repairs. So just so you can kind of get a feel for the type of neighborhood that I'm talking about, these are pictures from our first neighborhood in Toledo, the Old South End. Like other working class neighborhoods across the Midwest, the Old South End has experienced public and nonprofit investment over the past 5 years that is truly improving the community. It's resulted in ongoing infrastructure improvements, as well as new community offerings like the park that's seen in the middle. And in terms of renovation examples, I wanted to give you a better picture of that. You can see here a redone kitchen that we have on the left, and then a redone living room on the right. We just finished this renovation actually 2 weeks ago. And here's just another example of a renovation with a bedroom on the left and a completed bathroom on the right. Now, once we finish that renovation, a tenant actually moves in. Most of our tenants will have a subprime credit score or have a thin credit file that prevents them from having any credit score at all. We dive deeper and look at alternative indicators of financial health, such as on-time utility, phone, or other regular monthly payments. This allows us to understand the financial stability of the applicant outside of their credit score. We are currently talking with credit bureaus to purchase historical data sets. That way we can use those to create a more detailed, robust model. Over time, we can layer in the performance data that we're using to create a proprietary selection screening model that uses this holistic approach. So during the rental period, after that tenant's moved in, the tenant is paired with a nonprofit financial coach. They rent from us at a market rate while they build their credit score. The lease functions like a standard annual lease agreement with an addendum that contains the option to purchase the home for a predetermined transparent price. We differ from other lease-to-own companies in that we don't charge a down payment and we don't charge an equity premium in addition to the rent. What this does, it allows us to minimize costs for the tenants and maximize their ability to improve their credit score. Once the tenant meets underwriting criteria for a traditional mortgage, they can purchase the property. They are now paying a fixed mortgage payment that is cheaper than their rent, and they won't have to experience those rent increases anymore. Now, I'm really proud of what our team has been able to accomplish thus far. In terms of my background, I'm a Marine veteran, and following my service in the Marines, I led a social impact startup. I was also an Obama Foundation scholar my last year at Booth. Greg, who joined us this summer full-time after serving as the COO of interim execs, and he was formerly president of a nonprofit in Chicago called Minds Matter, which helps low-income Chicago public school students get into college. While getting my MBA at the University of Chicago, I assembled a student team shown on the bottom left to get LadderUp Housing off the ground. We were able to demonstrate viability and product market fit last year, as can be seen on the right with the various competitions that we were able to win and the traction that we've had thus far. After tying for second in the University of Chicago's Social New Venture Challenge, we raised additional capital and purchased and renovated 4 properties as a part of a pilot in Toledo, Ohio. We were able to acquire each of these properties for $22,000 on average, and were able to renovate the properties on time and under budget. This past December, we acquired an additional 9 properties. We finished renovations on 6 of those properties, and the remaining 3 will be done this month. Each property has been occupied within less than 3 weeks upon completion of the renovation. We've had 4 qualified applicants for each property that we've had available so far, and we built out a wait list without any marketing or advertising. Our goal is to acquire an additional 50 properties in Toledo this year and run pilots in 2 new Ohio markets. The following 3 slides show a couple of our completed properties along with the costs and the post-renovation value. So this was one of the first properties that we completed. It's a 2-bedroom property that we purchased for $31,000, put in $19,000, and had a post-renovation appraisal of $80,000 afterwards. This next property was purchased for $28,000. We put in $24,000 and then the post-renovation appraisal was $80,000. And this last property here was a part of that most recent 6 that we had completed, a 3-bedroom property that we purchased for $50,000, renovated with $16,000, and then had a appraisal after renovated value of $92,000. So our goal is not just to complete more properties this year, but it's to be the Midwest leader in creating this alternative pathway for homeownership. We very much viewed this as the beginning of a journey of growth for us. Over the next 4 years, we plan to grow to 1,800 homes in 15 new markets. And by the end of this period, LadderUp Housing will be generating $1 million of wealth each year for its tenants and homeowners, growing exponentially with more tenants choosing to buy their homes and building equity after our program. We plan to do this by being deliberate and responsible in the way we enter new markets and scale. We're conducting pilots in Akron and Findlay, Ohio this year with 5 properties in each city in the second half of the year. In the 6 months leading up to these purchases, we are building trust and community relationships. We are also vetting potential financial coaching partners and contractors while learning more about the communities on the ground instead of relying solely on remote research. At scale, we will be conducting pilots in 4 new cities each year and have a run rate of 50 homes in markets we have already entered. Before wrapping up, I wanted to say how excited I am about this lending opportunity. The current lending market for renovating homes in working class neighborhoods is broken. Following the 2008 crash, most banks pulled back from providing acquisition and renovation financing. In the private lending market, there are few available options because the renovated value of a home needs to be $100,000, which very much constricts liquidity. Further, the few lenders who lend for these properties have an onerous process that really doesn't allow for scaling impact. A tokenized ESG mortgage marketplace has the ability to bring debt capital to working class neighborhoods and also uplift communities while providing a compelling return.
All right, thank you, Tom. That was great, a great overview of everything that you're doing, and really excited to have you on board with LadderUp. So I decided to do an interlude halfway through the pitch presentation here with the Jimmy Stewart quote. And so this is a scene from It's a Wonderful Life. And you can see, you may remember this is sort of during the bank run scene in It's a Wonderful Life, but Jimmy Stewart says, no, please don't take the money out. It's actually not here. It's not in the vault. It's in this person's house. It's in that person's house. It's in the community. And, you know, when I was watching this movie just recently in December, it just kind of spoke to what we're trying to do. When you think about modern finance, we've really gone away from this idea of knowing where our money is, where is it actually being held, whose house is it going into, what communities is it impacting. And so we've kind of lost that Bailey buildings and loan idea where, you know, as consumers, we're just so used to modern finance that we just put our money in a bank, we're not sure what it's doing, and we just, you know, we've kind of forgotten that connection to community. And what we think we can do with this approach around decentralized ledger technology is make it so that we have that feeling. So we still get all the automation, all of the scale that we see in modern finance today, but we can go down to the very dollar and understand what are the impacts that we're having. And that's really exciting for us at SafeRate and why we wanted to put this together. And so when we think about an ESG asset, there's a couple of life cycle or a couple stages in a life cycle that we think about. So for an ESG asset to be created, there's a couple of things that need to happen for us on the ledger. The first is that we need to actually verify that there is ESG impact. This could be done by looking at things like the neighborhoods that we see that LadderUp is working with, the criteria of the borrower, so that we make sure that we're aligning with CRA guidelines or UN Sustainable Development Goal guidelines. Additionally, we need to verify that the information about the borrower is accurate. So obviously, if SafeRate was the only one on this decentralized ledger creating these loans, there's a risk that we might be lying to you, the end investor. And so we are actually bringing in independent third parties to attest to this information and review it so that we have as much trust as possible. Independent experts are sort of slicing off the part that's most relevant to them. We, in the case of LadderUp, we're of course doing renovation, and so we need to think about property. These are secured loans, and so we also need to attest to the details of the underlying collateral as well. In addition, we need to make sure the terms of the promissory note are effectively captured on ledger, the interest rate is accurate, things like that. And so just to bring an ESG asset online, the first step is to verify that all of this information is in fact accurate, and it's not SafeRate that's verifying this information, it's actually an independent third party. Then we move into the asset servicing stage. And so you can think of this as collecting the payments and then ultimately remitting the payments to our end investors. In some cases, for some ESG loans, you might need to continually assess the ESG impact, depending on the structure of the loan. And we also want to access just basic details, such as what is the current loan status? Is it current? Is it defaulted? Is it delinquent? Things like that. And so ultimately, this will be tracked on ledger as well. So investors have full purview, whether or not they're in the asset themselves. They can just understand the performance of sort of every asset that is live in this marketplace. And then finally, an asset does have to terminate. So once, in the case of LadderUp, after that renovation has successfully completed, they'll then refinance the property and exit us with that renovation loan. And so ultimately, we'll release our lien on the property and terminate that payment and ultimately remit the full principal to the investor. So as I said, let's just take a second just to drill into that asset creation aspect. So just to understand how this would work, first, SafeRate working with LadderUp would, according to the terms of our agreement, do financing on a new property. And so this would be done in a traditional legal framework. We would have title, all of the things that typically happen with a real estate closing. There would be a promissory note. So this isn't a pure Web3 solution. We're still very much operating in sort of this real world asset. And so what SafeRate then does is creates a smart contract that digitally represents all of the promissory note itself. And we actually deploy that smart contract to Hedera Hashgraph's decentralized ledger. And so once that's live, once we deploy that smart contract, an investor is not able to buy it because we haven't gone through those independent third-party attestations to ensure that it actually does meet the criteria. So now that the smart contract has been deployed, then one of our partners is actually going to review the physical promissory note and then review the smart contract itself, such as look at the interest rate on the promissory note, and then look at the interest rate that's represented in the smart contract, verify that those two align. Once that's certified, then they can sign it with their key and basically on ledger reflect that, hey, we reviewed this and SafeRate's information is accurate. If it needs to be updated, we as SafeRate can then update it and then go through the process again. Not to belabor the point, but this would also be true with underwriting as well. So we've looked at the legal document, we've made sure the terms align. The next step is also to review the underwriting standards, so to make sure that LadderUp as an organization meets the criteria that we've set forth as part of our agreement with our investors. And so that would be another review piece just to ensure that underwriting was done accurately as well. Additionally, then we'll have that ESG and CRA impact. So for example, if we're thinking about CRA eligibility, we would look at the address itself of the property, look that it does fall into a CRA eligible census tract, and this again would be done by an independent third party, and then they would similarly sign with their private key on ledger to say, hey, this does meet CRA eligibility. To be clear, SafeRate can never say that this is a CRA asset. So we do need an independent third party to do that. So sort of once all of these boxes have been checked, then it becomes eligible for sale, and then we can actually change the beneficiary from Safe Rate as the original lender to the end investor. And that end investor will be the one that's receiving the proceeds. And so this is sort of a highly permissioned environment that just makes sure that all of that information is flowing through, and that investors only receive assets that have been reviewed, verified, and attested to. Hopefully that makes sense. So now when we talk about Web3, a lot of people sort of get scared, and we want to be very clear that we're using this mostly for transparency and tracking. And so what this means is that you can be an investor into LadderUp's loans, for our pilot, whether you're a Web 2, and by Web 2, I just mean sort of like you're going to your online banking website, or if you're a Web 3, somebody who manages a Web 3 wallet, you will also have access to this investment opportunity. So what that means is that for some investors, Safe Rate can sort of manage the ownership and payment remittance, and it'll be similar to having an online bank account. You don't have to worry about all of the Web3 constructs of setting up a wallet, anything like that. We'll basically manage that for you. But there are some very passionate Web3 people who love sort of those constructs, maybe have their own wallet, want to custody the shares in the investment vehicle themselves. And so that group will have the option to basically receive payments in a USDC token. And so it'll be very Web3. And what's happening is we are setting up a legal investment vehicle. So similar to how the promissory note exists as a physical promissory note, the investment vehicle that we're creating as well will be a physical investment vehicle. It'll be a security. As of right now, we're exploring a Reg A or Reg D offering so that it is eligible for institutional and retail investors in addition to Web3. And then those shares themselves are actually going to be tokenized. So what that means is that there will be a digital representation of your shares as well. So in the case of a Web3 user, those shares will actually be in their own wallet. In the case of a Web2 online bank account user, those shares will show up in your account. You'll know they're there, but then Safe Rate is sort of managing it on your behalf. Now, you can sort of get a sense of what this will look like today. So as Safe Rate is a live mortgage lender, and we're actively servicing mortgage loans, not just for LadderUp, but with other customers as well. And so you can see our payment portal today, how we're collecting payments from our borrowers, and ultimately we'll be publishing this payment information to Hedera Hashgraph's decentralized ledger. Now, over the next 6 months, we're actually going to build out our investor view so that they can track their investment, their performance, and both Web2 and Web3 users will basically have this view to invest their money, track the performance and the impact, so that they have full purview. So again, just because this is powered by Web3 doesn't mean you have to learn a whole new technology stack if you are an interested investor. It'll be very much like online banking with the option to move to Web3 if that's your preference. So some people may look at this and ask, well, why are you doing all this tokenization? It seems like, going to Web3, it just might create more work. But there's really 3 main selling points for us that make us want to pursue this. So by tokenizing the shares, we're actually reducing costs. So we can see all of the shares that are outstanding. We know which users they're assigned to. And so ultimately, this removes the need for a transfer agent. There's a lot of efficiencies that come because now we're cutting out sort of traditional finance, just some of those more administrative pieces that we can absolutely accomplish on a decentralized ledger if we adopt that from the very beginning. Additionally, that means greater transparency. So if we say that there's 10,000 shares that have been issued in the investment vehicle, you can actually go and verify that for yourself on Ledger. So we can create a view so that all investors can see the total shares outstanding. And this gives investors confidence that the investment vehicle has been set up and the shares have all been identified and accounted for. Additionally, it allows us to do things like freeze asset transfers if there are KYC AML concerns that pop up, because all investors will still have to go through a KYC AML process, so it helps us sort of track and manage that as well. And then the last piece, and probably the most important for a lot of ESG investors, especially those that focus on private investments, is it allows us to create liquidity. And so it's really hard to create secondary markets for private offerings. It's often illiquid. You have to kind of sell shares, and there's a lot of uncertainty, a lot of doc review that goes with it. By us sort of adopting these constructs from the beginning, we can actually use some of the innovations that we've seen in decentralized finance. Specifically, we can set up a very simple swap where basically some investors could pledge their ownership into the investment vehicle along with a commensurate amount of dollar investment or stable coins, and essentially allow people to swap in and out of the shares of the investment vehicle. And so this would sort of be done in a passive manner. And so it removes sort of a gatekeeper ultimately who has to provide liquidity. It'll actually allow some of our other investors to earn additional yield and just make rolling in and out of the investment as seamless as possible. And that's something that we've really just been inspired by in tracking what's happened in DeFi, and something that we would love to bring to the ESG investors, especially for privates, where it's often a very liquid investment. And so, you know, we are creating an investment vehicle as sort of our initial pilot, but, you know, we actually do have really big dreams. And our dream is that every sort of ESG fixed income asset exists in this infrastructure. And so not only would this become a way for you know, a set of investors to collectively invest into ESG assets and achieve liquidity when needed, ultimately it could become a marketplace where there's actually many investors. And so just to think about it, let's think about a renovation loan with Tom. So once that renovation loan gets created and attested to, it's been independently audited, we'll actually publish to a topic, and then all investors can subscribe to that topic. And this is all done in Web3. And so it'll come online, and instantly all investors in this marketplace will be notified, hey, there's an affordable housing loan that's live, principal balance of this amount with this interest rate, and here's the UN ESG standards that it meets. It also meets CRA guidelines. And so I'm able to actually automatically bid on that investment. I can set up a rule or just some general guidelines, or I can track a daily publication and then ultimately reach out and try to purchase those assets. And so what's happening is because SafeRate has built the servicing technology is that we're actually handling that servicing aspect as well. So this allows institutional investors, accredited investors who don't want to deal with asset servicing. Well, now because everyone's sort of operating on the same servicing software and we're handling the payment collection and remittance to end investors, it makes it so that investors who don't want to do the operational aspects of managing or investing into ESG assets, it's kind of taken care of for you. But you can track the performance. All of those things will be reported on Ledger. So you're still getting that full transparency, full auditability, but then the operational aspect is really taken care of for you. So this pilot is not just the idea of, you know, one party. Obviously, we've been heavily involved with SafeRate, but we've sourced a number of incredible partners to bring this concept together. So LadderUp was really the first investment that we wanted to bring the opportunity to. We originally met Tom. We're similarly alumni of the University of Chicago, and we're just excited to connect and see what he's doing, and seeing all the traction he's made and just repeated success he's achieved gave us confidence. And in addition to the needs for small dollar balance lending in these markets, really inefficient markets, it's just a great proof of concept for us. We also have First Title and Escrow, who will help us verify the collateral details, and Stephen will talk here shortly. We're working with Toko, which is a tokenization engine that was originally developed within DLA Piper, a global law firm. And so Toko will be the one that's responsible for tokenizing the shares with us and helping us set up that security. Now, the investment vehicle that we're creating, it'll actually be audited by Markham. Since we are a mortgage lender at SafeRate, we have worked with Markham for several years on our audits. And so they've been a trusted partner for us throughout the years, and they will, on an annual basis, audit the investment vehicle itself. We're targeting IntelliCredit, which is a group based in North Carolina and in Chicago that has a lot of credibility and strength in loan review in the sort of community banking industry. And so they're helping us attest and verify the underwriting standards, the CRA, ESG, and items like that. So they'll basically be the ones that are auditing the individual notes themselves. Now, all of this information, as we said, will be tracked on Hedera Hashgraph, and we've been working closely with their Enterprise Accelerator program, and there are just a number of potential partnerships that can come from this. I can just share that Hedera has been really excited by the opportunity to ultimately have a fixed income ESG market that's fully live on their ledger. There's many aspects we like about Hedera Hashgraph, and there are probably too many to go into for this presentation. A lot of people have their favorite Web3 network, and I'm happy to answer questions as to why we chose Hedera for that, for this specific use case in the Q&A. Another great partner of ours is actually another decentralized ledger network. So Oasis Labs has recently deployed their Sapphire network, and they allow us to secure information in a highly confidential way using technology like zero-knowledge proofs. And so when there's information that needs to be sort of hidden, then we'll actually use Oasis Labs and Sapphire. So things to think about is like when I go through the KYC AML process, that linkage of, hey, this is Dylan Hall, the investor, we're going to make sure that all of that information is ultimately confidential and protected. And Oasis Labs and Sapphire, their sort of privacy leading approach is really a great use case for that. And we work closely with the team at Oasis, and they've been a key partner for SafeRate in the past. Now, when you think about the different roles, there's sort of two categories we slice them into. One is for the ESG asset tracking, and the other is for the tokenized investment vehicle. So the ESG asset tracking, there's different roles like originator, which would be SafeRate, borrower, that would be Tom and LadderUp, and then verifying the collateral, the underwriting, ESG, ultimately a loan reviewer, mortgage servicer, which would be SafeRate, and then custodian to manage the document. And so basically all of these partners are coming together to fill out these roles. For the investment vehicle, we have tokenizing the actual securities, and then our auditors as well, and then that KYC AML verification process, which is happening in partnership with Oasis and Sapphire. So it's a multi-stakeholder ecosystem. It's not just SafeRate, it's not just LadderUp. It's many parties coming together to create really high quality ESG assets for end investors who want to have that impact and generate a market rate return. And so I'll just ask Steve Papermaster of First Title and Escrow to talk about his role in this ecosystem.
Thanks, Dylan. I appreciate that. I want to make sure you can hear me and apologize for any background noise. I'm actually in the airport right now.
Yes, we can hear you.
Thank you so much. So First Title is a national title and closing services company based in the DC area. We support both origination lenders, banks around the country, as well as servicers and GSEs in the default services space, as well as law firms. I just want to take a couple minutes and talk about the current state of real estate transaction transparency. Obviously everyone knows we have a land record system that looks at, recorded mortgage documents, and that's how we originally go and build the chain of title. What we believe that with the opportunity to record onto the ledger, there's a number of things and other gaps we can fill that aren't currently being looked at today that are very important. Today, the transparency comes in three forms in the process. First, when an order or a contract is placed, a title insurance commitment is being delivered, and that identifies a lender being in first position and delivering a document confirming that the lender will be in first position, whatever position they're expecting to be in, on condition that certain requirements are being satisfied. And that's what's the most important thing. In title and in a transaction, we're certifying as a title agency or escrow company that we're paying off judgments, liens, assessments, HOA, taxes, etc. That's the first form of transparency today. The second form, of course, I mentioned is the recorded mortgage. And as you may know, that mortgage recordation in some cases is not verified back to a lender for weeks or months after it's performed. And then lastly, there's a title insurance policy that is a piece of paper that's delivered to a lender or an owner of property that confirms that they own this piece of property. what we believe or what we will be able to do with this partnership with SafeRate and Hedera Hashgraph is to bring additional transparency that really isn't spoken about today. What we'll be doing is, of course, delivering the data points back associated with the complete chain of title, which of course makes a lot of sense as opposed to a paper-based commitment that's rarely cataloged by a lender or secondary market purchaser or whatever of that loan. They just simply keep the document. The most important second part of this is, in addition to those data points of the chain of title, is what happens following disbursement of that transaction. So where the lenders and owners are getting an information delay is all these little disbursements that are being paid that are very important. And when I say little, we're talking about taxes, homeowners association, insurance payments, mortgage payments, back to pay off lenders. So what happens traditionally today is that an escrow company will pay a mortgage lender off within a day, 24 hours of that loan being dispersed, but there's no information being delivered to the former lender or to the new lender that this loan's been paid off. They're just assuming it's been paid off. And the reason why it operates like that today is because the title insurer, let's say the First American or the Stewart Title of Fidelity, provides what's called a closing protection letter that tells all the parties the agency that's dispersing on your loan is going to do all these things for you. They don't require that you deliver the information. They just require that the items get paid or get satisfied. So what we're going to be doing on the blockchain is to simply, on delivery of that closing, we're going to be delivering all of those data points relating to the payees, the dates. So you'll know the second that loan is sold or the transaction's completed, when an HOA was paid, when the mortgage was paid. You'll have payee information, you'll have dates, you'll have wire information, you have all this critical data that's very important to the transaction that people aren't asking for today. And you'll see years back going into this title industry, there's history of defalcations where a company could close a transaction, not pay off a mortgage loan, a prior mortgage loan. It continues to be a lien on that property. And that bad actor can continue just to pay that former owner's mortgage payments and steal that money. So we're talking about pure protection against fraud by reporting onto the blockchain. So it's just so important, as you can see as I'm talking about this today, how much that additional information is going to help, we believe, in creating more value for these loans. I know in the big scheme of things, a purchaser or seller is assuming all these items get done, but there's a lot of gaps in the process we see that we can resolve through this partnership. So really excited that we're working on this with you, Dylan. And any questions, I'm open to discuss. Thanks.
Great, thank you, Steve. It's been and just, as a mortgage lender, we've definitely seen these issues firsthand and just incredibly excited to work with Steve. One thing that became really clear was, as we were starting to explore, how do we, make this as effective as possible? Obviously, we want information to be transparent, but if we also just make really high quality assets, we believe that ultimately investors will be better off and we'll have a much more trusted marketplace. And so Steve's work, in getting into the details of title and settlement. Most people don't enjoy mortgage closings. I'm sure Steve actually does. We do as well as SafeRate. It's just great to know that all of that information will start to be recorded and independently attested to. That's just incredible for us. And so really excited to have Steve on board.
Thank you, Dylan.
So, as you think about, hopefully you've learned something. If you're interested in being a part of this initiative, our plan is to be really public with quarterly check-ins. And so if you're somebody who's just like, hey, this is interesting, I don't know how I can help, but I just love what you guys are doing, absolutely just feel free to send us an email with that news. We like positive reinforcement. So you can email us, Dylan at SafeRate, Shima at SafeRate, or if it's easier to remember, team@saferate.com. And then happy to just keep you in the loop and make sure that you're aware of any future webinars where we kind of continue to share our progress. We are also looking for impact investors. So, that's open to institutional, retail, and Web3. So no matter which bucket you fall into, we're absolutely interested in sort of identifying that pilot group of users, and with the understanding that our first investment offering will be those LadderUp renovation loans. And so if you kind of fit any of those buckets, feel free to let us know. We would be really excited to speak with you. What we would, of course, ask is not only for you to be excited about the investment opportunity, but also that you could be a beta user as well. Help us as we're building out the investment website, just give feedback to make sure we're communicating the right information to you. And so hopefully you can be comfortable being an early adopter as well. And then we're also interested in speaking with corporate partners. So SafeRate is a lender in this ecosystem. Obviously, there's a lot of mortgage lenders out there. So if you're a mortgage lender who's seen this and said, hey, I'd like to be a part and just monitor this, and maybe we can adopt this framework in the future, we would love to do this. The goal here is to create an ecosystem of partners, and we really do mean that. And so we want to get more and more groups, even if they're sort of in similar industries or operating in the same industry, to be a part of our pilot. And especially if they're really large scale, larger lenders, we're happy just to help you understand how to use Web3, for example. And so feel free to reach out if that's where you fall and you're just a corporate that's interested in kind of learning more and following our progress with this initiative. Now, in terms of our expected timeline, for Q1, Q2, Q3, and Q4, that kind of means as of today. So so for Q1, think about that as 3 months starting from today. We'll basically be setting up the investment vehicle, begin lending, servicing, and remitting payments, and that'll be live via Web2. So that'll be done on our website. We've fully integrated with things like Stripe to be able to process payments and send that to investors. And so that will be fully live. For Q2, that's when we'll actually begin the tokenization. So any loans that were originated in Q1 will then sort of bring on Ledger as well. And so that will be done in partnership with all of our partners. There's some work in Q1 just to make sure they have everything they need and to get them set up. And so by Q2, we'll have that asset verification, performance tracking, and all the tokenized shares available. So that should be completed within 6 months. And then by Q3, so by the end of 9 months, we'd actually love to open this up so that anybody could come to SafeRate and begin investing, whether they're Web2 or Web3, institutional or retail. And we understand this is ambitious, but we have done a lot of work on our SafeRate website to date to get this live. And so we absolutely do believe it's in the realm of possibility and hope to begin just onboarding the general public, as early as Q3. And then for Q4, we'll start to move into giving people a liquidity option. And so allowing them to roll in and out of the shares, create a liquidity pool with USDC stablecoin. And so if you understand what that means, you get it. If you don't, you might have to rewatch the talk or just feel free to send me a message. But essentially, the transparency and liquidity will be there for Web2 and Web3 investors. And so that covers the timeline. I'm just going to check the Q&A really quickly. And looks like we had one question. And Tom, if you're still around, maybe you can help with this or piggyback onto my answer. But one of the questions that came up with, so LadderUp Housing is doing the improvements. And so how will we go about verifying the improvements? And Tom and I have, we haven't finalized our approach here, but we do think one way is to basically provide video evidence, sort of a before and after, and actually record that video and have it available for investors to review. Tom, is there anything you'd like to add to that?
No, that was it. And just in case the question was a little bit more towards like the energy efficiency portion of what we do, I just want to address that as well. So when we buy, like, for example, that new kitchen with the new appliances or the washer dryer, those are all efficiency type units. And then half the homes, for example, we've ended up putting new roofs on as part of that systems issue that we mentioned before. But we haven't gone through getting our houses certified from like a from a sustainability perspective. The reason being is that we really want to be customer centric in terms of what would result in a positive payback for the tenant as their rent exists today and then their future mortgage payments in the future. And just some of those particular investments didn't end up making sense from a cost perspective for our tenants. And that was our number one focus, is making sure that we could have the lowest cost structure possible so we could include as many folks as possible from an affordability standpoint. So just want to address that angle of the question in case it was about the energy efficiency piece too.
Perfect. Thank you. Yeah, that's perfect. And looks like that's it for questions. As I said, if you do have any follow-up questions, we'll probably send out the video by Monday in the follow-up with any other additional Q&A that come up. So feel free to provide us with questions, going through to the weekend, and we can absolutely get you feedback on that as well. And again, if you're interested and just want to be in touch, please do reach out to us at saferate.com. It's really easy to get in touch with us. And just want to say thank you again to Tom and Steve for walking through this vision. I'm really excited to be a part of this. Just the opportunity to know that we can get people to achieve home ownership on as little as $18 an hour in Toledo, Ohio. I think that's incredible. But also there's a huge opportunity to scale the impact, and what Tom's work is doing looks incredible. Looks like we do have one question. Let's see. What does the contract look like for tenants to switch to a homeowner? Can you share some more details on that, Tom?
Yeah, so the way that the contract's structured is a standard annual lease contract. And when the tenant, and there's an option to purchase that's an addendum to that contract. And when the tenant can get traditional mortgage financing, then they can purchase the property from us at that predetermined transparent price. So we're not a land contract. It's not a contract for deed just because of all the negative incentive structures that exist with that. Basically that lease renews each year, and we expect it to take on average 3 years for a tenant to be able to purchase. As it currently exists, we're getting takeout financing from local banks right now. So we have 2 local banks that we've done refinancings with and a credit union in town here. So when the tenant is purchasing the property from us, we're just retiring that existing debt on the property. We're not actually like seller financing it, or that's not moving to the tenant once they purchase it.
And I really loved, I'll just add, having followed this space as well, I think Tom's approach and LadderUp's approach really makes a lot of sense because there are some sort of equity building arrangements, but those can be hard to unwind or basically lead to a renter losing equity if they start to miss payments on the rental. And I think Tom's approach just does a really good job of kind of, flagging, hey, I'm in the rental stage, but giving them confidence that once they are able to transition to become homeowners, they can move into that purchase stage at a lower monthly